Hey guys, welcome back to the Success Seekers. My name is Jesse, and thank you for tuning in to November's dividend portfolio update. So today we're going to be going over a recap of what's happened in the last month as far as any investment changes, any dividends I've earned in this account, and we're going over any changes I may have made to the investments this month, and just kind of seeing where we're at now. So before we jump right in, make sure you hit the like below, subscribe to stay tuned to future updates, and yeah, without further ado, let's do it. All right, so here we are in M1, which is the portfolio I have for my dividends, the brokerage I use for my dividend portfolio. And as you can see, last month, if you guys remember, I said that I wanted to start my videos before I hit 1,000, and we actually passed 1,000 in the account today. So this is a cool, really nice milestone. And yeah. So first off, I want to tackle and look at the returns. So we are down 5.73% in this portfolio. That is actually a lot better than where we were last month. The market has kind of rebounded a little bit, and we've sealed off some of those losses. They've now flipped it back up to gains, which is nice. The earned dividends is up to $6.27 so far in earned dividends, and we're down 42 in the market, so that evens out to a minus $36 gain and with a 5% negative return. And so here we are at, here is my different funds between core growth, defensive, grocery, financials, restaurants, real estate, industrials, tech, and energy. Let's go over the biggest and lowest gainers as far as sections. So right now in the lead is tech, up almost 8% in the green. Energy is a runner-up at up 4%, and we have real estate barely breaking even, up 1%. In the middle, we've got restaurants doing okay, I guess, a little bad. Core growth is down by 7%, and our biggest losers for this month's update are industrials, grocery and defensive stocks, and financials. So let's flip this back around. Okay, so let's go to earned dividends for this month. What has happened since the last update? So since the last update, we have earned, let's see here. It looks like we earned 17 cents in dividends from JP Morgan. So that's super awesome. Those Chase dividends came in. And we earned 1 cent from QQQ. Now, I don't want QQQ in my portfolio for very long. I want to trim down and make my investments a little more narrow in this account. So we're going to go into that here in a second on why I only received a penny from QQQ and how I soon won't be receiving any. So those are the dividends I've received since the last update, 18 cents between Chase and QQQ. Now, let's go into morning trading. So on November 1st, it triggered my monthly buy, and I bought 6 stocks. Here's what I'm buying. I bought $7 in Exxon Mobil, $3 in Deere, $4.61 in Van Eck Vectors Semiconductors ETF. So this is things like NVIDIA and Taiwan Semiconductor, stuff like that. They make chips. $10.56 in Caterpillar, $4 in Apple, and $30 in jepi. That was automatic. Whenever I put money, the first of the month hits and it pulls money out of my bank account to throw in here, it automatically invests in different stocks based on where it can bring the actual percentage up of my portfolio to the target. So when my next buy triggers, it's not going to buy any stocks in this grocery defensive section, because I have 12% on my portfolio, those stocks already, when I have it set to be only 10%. Now, if we go to, like, let's say energy, my next buy is going to buy some more energy stocks because I want 5% of my portfolio to be energy, but right now it's only 4.2%. Does that make sense? So those are the dividends. Nothing crazy I've earned so far this month, but I am up $150 and I've only put 60 in it because we just have had such big market gains, which is really nice. So let's go to holdings. And let's see. Actually, let's not go to holdings. Let's go to portfolio and go over the last quarter. So if we go, I guess this does have the cash I've put in it. So let me see if there's a better way to do this. I think this might be the best way. Maybe if we share pie. Maybe if we do this. Let's see. Okay, yeah. So if you look in this last quarter, we're down 5%, but look right here. Between videos, updates I made, we went to a really big low, the biggest low we've had in the portfolio so far, and back up. Look at this curve. Right down, then shot right back up. I hope it keeps going in this direction. That's because the Fed paused their rates for the second session in a row. So optimism is high that we're not going to have increasing interest rates from this point on. The last month, you can see we were really down, then we shot back up. Last week, none. But yeah, this right here, this complete reversal of the chart is what brought us back up from, I think it was down 10%. Now we are down just 5%. So that's encouraging. That's awesome. I knew that would happen, but it's nice to see that happen already. I thought it would take a lot longer for a reversal to happen. Now, I want to go into some changes I've decided to make with my holdings here. So over here in my core growth, these are supposed to be the stable stocks of the portfolio. I had I think it was 30% dedicated to jepi and 20% dedicated to VYM. As time goes on, I'm realizing I'm not a fan of VYM in this portfolio. VYM is a high dividend yield ETF, and I just feel like the portfolio is too diversified. It's good to have diversification, don't have your eggs all in one basket, but this is a little too much, because when you look at how many holdings VYM has, VYM holdings, full list, VYM has a long list of holdings. So when you invest in this ETF, you are getting more than just that one stock. You're getting all the stocks that the fund invests in. Now, let's see if there's an easier way to put this. VYM holdings count. VYM has 454 different stocks. So when I put money into VYM, I am putting money into 454 different dividend stocks. Now, this is supposed to be a fund at its core of my favorite dividend stocks, with a couple ETFs in here to make sure it stays stable. When I'm putting money in VYM, I feel like my money is becoming way too diversified into dividend stocks I might not care about. Sure, being that diversified in an ETF makes it pretty steady, reliable. Diversification is good, but I just want to narrow it down. So my plan is eventually to get rid of VYM and just have schd and jepi in here. But for now, what I did was I evened out jepi and VYM to both be 25% instead of, I think it was 30% in VYM, 20% in jepi, or the other way around. I want to keep dollar cost averaging into VYM. That may seem counterproductive, but I want to keep putting money into it each month. And once we break even with VYM, I am selling out and putting it into schd and jepi. I want to narrow down what I have in here down to just two. schd, which is basically doing what VYM is. It's a highly diversified dividend fund. And jepi tracks the market and gives you high dividend returns based on the market growth. So yeah, cut out VYM, bring down schd, and jepi is something we're planning to do in the near future. And then also one more thing I did was over in tech. In tech, I have Microsoft, Apple, SMH, and QQQ. I love Microsoft, love having Apple, love having the semiconductors as well. That's been a big return. Chips are just super important and needed. QQQ was to diversify into more tech, but QQQ is not just tech. It's kind of just an S&P 500 tracking fund. I feel like it doesn't really fit in here, and it's also, again, it's causing a lot of diversification when I really just want to hone in on my favorite dividend tech stocks, which are Microsoft, Apple, and SMH. Those are my three favorites. I don't have anything else. I barely have all three of those in here. Like, I honestly would just have Microsoft and Apple, but I like SMH enough. QQQ, I don't love it enough to have it in here. So I had it at a target, I think, of 1%, because I was like, oh, I don't want to buy any more of this. But I upped the target to 10% because I want to make sure I'm putting dollar cost averaging into it. Otherwise, it's going to break even way later. It's going to take way longer for it to get back up to what I spent. So I'm going to continue to dollar cost average into QQQ. Once we get in the green, selling out and bring it down to just Microsoft, Apple, and SMH. So that's where I'm at with tech. So yeah, that's kind of just an update on my portfolio. I'm trying to think if there's anything I may have forgotten. I don't think so. I'm just really excited to keep you guys up to date on what's going on. I think a quick thing I can do real quick to show you guys, so you know what's in each fund. My core growth, I think I did do this last video, but let's go over it again, is the schd. It's jepi and VYM, with my best performer being jepi right now and my worst being schd, down 5%. I then have my grocery defensive. This is Kroger, Target, Hershey, and Costco. Eventually I want to get this down to 3, but I'm liking all 4 right now. So for the foreseeable future, I'm going to keep it these 4 stocks. My biggest loser is Hershey, down 18%. Now, once I can start buying a little bit more of it at this price, it should even out. But Hershey definitely is down a lot right now. And then my biggest winner would be Costco. It's pretty much break even. But this whole sector as a whole is not doing too well for me right now. And then we have my financial sector, which is MasterCard and JP Chase. I used to have, I think, 4 stocks in here between MasterCard, JP Chase, PNC, and Discover. So glad I've got it down to just 2, my 2 favorites, JP Morgan and MasterCard, which are both down 8% right now. Now let's go to the next one is my restaurant sector. Texas Roadhouse and McDonald's. McDonald's is down a little bit at 5% down, and Texas Roadhouse is almost break even at down 1.66. I like slightly more Texas Roadhouse in here than I like McDonald's. And then we're at my REITs is literally just one. It's O. It's up 1%, which is awesome because I've been spending a lot of money on O recently while it's been down, so it's good to see that in the positives again. And I like O because it has a monthly dividend return. You get a dividend monthly. Industrials. Caterpillar and Deere are both hit hard right now with down 8%, but those are the 2 industrial stocks I like. It covers farming and it covers construction. And then let's go to tech. Again, I have Microsoft, Apple, SMH, which is the semiconductor chips, and QQQ. And almost all of these are in the green. It's nice to see tech up. Tech's a big winner right now. And energy. Energy is just ExxonMobil Corp, which is the production of oil. And they're up 4% right now. Yeah, so that's kind of an update for you guys. We're entering November at $1,000 in my portfolio, down just 5%. And let's go over what kind of dividends I will be receiving in November. For November, I should be receiving, let's see, actually there might not be a way to track that. Okay. Then I'll come up with a way to see whatever future dividends I have coming up. I think there is an app I'm working on that I recently downloaded, trying to implement everything from this portfolio into that app so I can get updates on it. So in the next video, I will include what future dividends are coming, as well as what I've received already. So I went over, that I have received from JP Chase and QQQ this month. Next video, we'll go over which dividends I just received and what's about to come up. But yeah, guys, thanks for tuning in. I look forward to the next video. See you guys.